Hi, and welcome to the Day Trading for Beginners podcast. This is season 2, episode 6. And in this episode, we're going to talk about margin. So we're going to talk about what margin is, and we're going to sort of explain it for beginners. So my name is Tyler Stokes. I'm on a journey to become a full-time day trader. In this season, we are studying a strategy, but I thought I would sort of stop the strategy focus and just do a few episodes where we talk about some key concepts and terms that you're going to come across in this phase of your journey. And margin is one of them that I sort of wanted to talk about before, but I thought now is a good time. If you're starting to potentially open an account, certainly now in my journey, I'm not going to be trading with real money, but we have opened an account and you've probably heard about margin before, but I just thought now would be a good time to sort of do a full podcast and try and get a good understanding of what this is. Now, if you've been following along, you can certainly download my 6-month blueprint that outlines everything that I've done in the first 6 months of my journey. And you can find a link to that in the show notes below, or you can go to stokestrades.com/blueprint. So let's talk about margin. So, I've heard about margin. I sort of knew, what it was, but I really didn't have a full grasp and a full understanding of it. And I think this is something that many beginners sort of will deal with as well. Like you've probably heard of it, but do you really understand, what margin is, how it works, and some various components about it? Maybe you don't. So if you want to sort of just imagine having the power to buy more, stock than your cash would allow, but also knowing how to manage the risks that come with borrowing money. That's sort of like the concept of margin. So in this podcast, what I want to do is break down what margin is, talk about margin requirement, things called margin calls, and then buying power as well. And the idea and the goal here is so coming out of this podcast, you can sort of confidently use margin when you are ready to trade, without being caught off guard by some of the risks. So again, if you're a beginner like me, you're probably not going to be trading with margin right away, but it's good to understand what these concepts are. When you actually go to trade real money, you sort of have a good grasp of margin and you sort of don't make some mistakes that people can make with actually using margin. Okay. So, what is margin? Well, at its core, margin, it's a loan from your brokerage. So when you open a margin account, your broker allows you to borrow money to buy more, stocks or securities than you could with just the cash in your account. So this borrowing power can help you amplify your gains and your losses because you're using both your funds and then borrowed money. So very simple example. If you have $1,000 in your margin account, your broker might allow you to buy up to $2,000 worth of stock. So $1,000 of your own money, and then you borrow $1,000 as well. And then depending on, the margin rate and the type of assets that you're purchasing. But basically, that's the power of margin. It increases your purchasing power, but you need to remember you are borrowing money. And when you borrow money, there comes some risks. Now, in terms of actually setting up an account and doing what real day traders do, professional day traders, they're going to typically use a margin account rather than just a pure cash account once you start sort of trading professionally. And some of the reasons, basically just the definition of margin, you get leverage, right? So in margin accounts, like we just explained, it allows you to borrow money from your broker and it increases the buying power that you have. So it gives you that ability to control larger positions than you could with just your straight up cash account. So, for some day trading strategies, you might be making profits off small price movements. So having that extra margin can be worthwhile. And, I think most professional day traders certainly use it to some extent in their trading strategies. Now, the problem with margin accounts in the US is this thing called the pattern day trader rule. So the PDT rule. I'm going to talk about this in greater detail in some future episodes. But what this rule entails, it applies to margin accounts and it requires that account balance in this account is maintained at $25,000. And that's for mainly in the US. So I'm in Canada. There is no PDT rule in Canada. My margin account doesn't need that specific balance. And if you're in Europe or other places around the world, you're just going to have to find out if your geographical location requires this PDT rule. I think for Europe, it might depend on various countries, but I think this is mainly a US thing. But basically what this means is that you need to maintain $25,000 in your margin account if you're making more than 3 day trades within 5 business days. So this rule, again, it doesn't apply to cash accounts, but the limitations in cash accounts, which we will discuss, basically having your cash settled for various periods makes it less practical for actually day trading. So if you are in the US, and if this rule, still applies when you get ready to trade professionally, you will probably want to have $25,000 in your margin account. But we're going to do a full podcast on that and talk about some ways to get around it. And one way is a cash account. But if you're a professional day trader, then there are some limitations with cash accounts. So a margin account allows faster trades because in a cash account under US regulations and various other geographical regulations as well, perhaps, there's this thing called a settlement period for trade. So it's typically the transaction date plus 2 business days for buying and selling stock. So what this means is when you sell a stock, you must wait 2 days before you can use that cash to buy another stock without being considered a free riding violation. So a margin account doesn't have that. Traders in a margin account, you can bypass this waiting period since you're essentially borrowing against your portfolio's value. So there's no settlement delay. But in a cash account, there is. So if you are going to, not have a $25,000 balance in a margin account, and you want to day trade with your cash account, you're just going to have to watch your balance and know that money that you buy and sell on a particular date, you can't use those funds until T plus 2 days. So you'll just have to kind of watch your balance and not trade your full balance in a cash account. Again, we're going to talk about that in more detail in future episodes. But the main takeaway here is that most day traders, eventually you're going to prefer using a margin account because it provides leverage and faster access to capital, both of which are essential for frequent trading. Again, margin accounts do have the extra risk low. So let's continue, moving away from that tangent. Let's get back to margin and then talk about some things called a margin requirement. So when you have your account, the broker that you are with, they're going to have specific margin requirements. Now, these are minimum amounts of equity, so your own money that you must maintain in your account before the broker allows you to use margin. So there are 2 main types of these requirements. There's initial margin and then maintenance margin. So initial margin, this is the amount of your own money that you'll need to have before you can borrow from your broker. So for example, if a stock requires a 50% margin, you'll need to pay half of the stock's purchase price with your own cash, and then your broker will loan you the other half if you wish to use margin. And then there is something called maintenance margin. So once you have stocks purchased on margin, you'll need to maintain a certain level of equity in your account. So this is typically around 25% of the total value of your positions, but it varies by broker. So if your equity falls below this level, your broker may issue a margin call. And we're going to go through an example, a really simple one, so you can understand your initial margin, what your maintenance margin is, and when the stock fluctuates up or down, what would trigger a margin call. So we're going to run through an example. But basically, margin requirements, what these are in place to ensure that you always have a certain amount of your own money at risk, reducing the chance of borrowing too much. So sure, you can borrow, but you need to maintain these percentages of your own equity just so you aren't left in a really bad position where you might, lose all your money. So what happens if, your equity is going down to a percentage that sort of triggers a red flag? That is called a margin call. So a margin call, that happens when the value of your account falls below the maintenance margin required by your broker. So when this happens, your broker will require you to deposit more funds or sell some of your positions in order to bring your account back into the proper compliance or the proper percentage based on the margin requirement. So let's say you bought $10,000 worth of stock on margin with $5,000 of your own money, and then you borrowed $5,000. So there's that 50% initial margin. So if the stock's value drops, your account equity may fall below the required maintenance margin. And then the broker is going to issue you a margin call. And basically the call could be a call, or sometimes it's just an email. And they're going to tell you, you need to deposit more money into your account to bring your percentage of equity up, or you need to sell some of your positions in order to pay back that margin loan that you took out. So a margin call is your broker's way of making sure you don't fall too far into debt. If you don't meet the call, and if they say, you need to deposit more money to get your equity up, then your broker can actually liquidate some of your positions, sometimes at a loss. So this happens sometimes, if a stock is crashing and everyone's bought a lot on margin, there are going to be margin calls where, the stock is falling, you're below the required equity percent there, and their broker is going to say, listen, you need to sell at these low prices to get that equity, get that percentages back where it's supposed to be. And many times, people are forced to sell at the bottom because they were on margin and there were margin requirements and they got a margin call. And it's really not a good thing. So margin in certain areas can be a bit of a dangerous thing for certain situations. Now, what happens also is this thing called your buying power with margin can increase. So, the biggest appeal really for trading with margin is this idea of having an increased buying power that it provides, because your buying power really refers to the total amount of stock or securities that you can purchase using both your own money and then the margin loan from your broker. So again, most brokerages offer something called a 2-to-1 margin for stocks. And again, you would really want to read up on the margin documentation in the brokerage that you are affiliated with. But basically 2-to-1 means that for every dollar that you have in your account, you can borrow, $2 worth of stock. So, or 2-to-1. So if you have $1,000 in your account, you can buy $2,000 worth of stock. However, for some day trading requirements, they offer even better margin buying power. So you might get a 4-to-1 margin. So that can significantly increase your buying power, but it exposes you to more risk as well. So you have to be careful when you deposit money in a margin account. You're going to get your cash balance, but you'll also get a reading in your account that shows your buying power. And sometimes people get confused and they think their buying power is the amount in their account, but your buying power does include the component of margin. So, you have to be careful. If you deposit money and you forget what you've put in and you look and, your cash account might be 20,000, but your buying power could be something like 35 or something like that. And then you go out thinking that you have all that money, but really you're trading on margin, you're borrowing money. So be careful when you're reading in your account. Your buying power is not all your own cash. That includes money that you would potentially borrow from your broker. So again, margin gives you more buying power, but it also magnifies your risk, especially with some day trading strategies that, involve frequent trades at smaller movements. If things go the wrong way, then you could be trading with margin, losing with margin, and suddenly, you can be getting into a position that you don't want to with your account. So there are risks, of naturally using margin when you're borrowing money and trading with it. Obviously, risks will come up. So it's important to remember that trading on margin, yes, it amplifies the gains, but it also amplifies your losses. So while you can increase your buying power, you also lose more than your initial investment if the trade goes against you. So if your account value, really drops a lot, you may face those margin calls and then you'll be forced to either pay more money or sell at a loss to get rid of your margin. And that can really, really hurt you. So you really need to be careful. So some key risks, include increased losses. We talked about that, getting a margin call, interest as well. So when you borrow on margin, money is not free to borrow. If you trade on margin, you're actually borrowing. So there is going to be, a monthly fee that your broker will be charging you for using margin. So I hope that was kind of clear. What I thought we'd do now is just actually run through some examples. And I think when you hear these examples, or for me personally, when I ran through them, it just gave me a better understanding of margin requirements, and margin call. So let's run through 3 examples. And one is going to be when the stock goes up. So that's going to be great. And we're going to make more money than we would have if we didn't use margin. And then we'll go through some examples where the stock goes against us. So let's pretend stock A rises in value. So if we want to just pretend that our initial investment was $1,000, that was our own money. And we also borrowed $1,000 from our broker. So we have $2,000 in stock A. We invest $1,000 and we borrow $1,000 on margin. So we have a 2-to-1 margin ratio there. And we bought, 100 shares of stock A at $20 per share. So we got $2,000 worth of stock A. We have 100 shares. Now stock A increases. So after some time, the price of this stock rises from $20 to $30 per share. So now our 100 shares are worth $3,000. So we can sell the stock for a profit. So let's decide to sell all the 100 shares at $30 per share. So we have $3,000 of profit. And now we want to repay our loan that we borrowed from the broker. So that would happen automatically when you sell. And we are left with $2,000 that is ours. Now, since we originally invested $1,000 from our own money, we made $1,000 pure profit. So we used margin basically to double our buying power. Stock A increased in value, allowing us to make $1,000 profit. So it's basically a $100 return on that initial investment. No margin call occurred. Stock went up and we, paid back our margin. Now, if you actually compare that to just using your own $1,000, you can kind of see the power of using margin. So if we broke that down and we only invested $1,000, we would have just been able to buy 50 shares at stock A. So stock A was trading at $20 per share. If we just had 1,000 instead of 2,000, we would have 50 shares. When the price went from $20 to $30, our 50 shares are now worth $1,500. So 50 shares at $30 now. So we really only profited $500 from that $1,000 investment. So again, with margin, when we can borrow that extra $1,000 and buy 100 shares, we gained $1,000 in profit when the stock just went from $20 to $30. But without the margin, really, it would have just been a 50% gain. So our $1,000 initial investment, we just gained $500 in profit. So sometimes you really need to write down just some napkin math to see that using that margin really gives you a much higher degree of potential earnings than just using your own money. So again, the key takeaway there, by using margin, what we effectively did, we doubled our buying power, which also doubled your profit. So while, we would have just made we would have made $500 of our own if we just invested that $1,000 and the stock went from $20 to $30. Because we bought on margin, instead, we were able to, earn even more. So that is really the power of margin. And that's just one small example. If you compound that over, a year of trading with margin or for larger amounts, you can certainly see the appeal of trading when things go right. If stocks jump from $20 to $30 and you're able to use your $1,000, but also, $1,000 of money that you borrowed, suddenly things are looking really good. But stocks don't always go up. They can decline. So in this next example, think of it when the stock declines in value and then a margin call is triggered. So for the initial investment, let's pretend we've got $1,000 and we borrow $1,000. So we have $2,000 and we're going to buy stock B at $20 per share. So we've got 100 shares of stock B at $20 per share. $1,000 is our own money. $1,000 is money we borrowed. Now, unfortunately, stock B drops. It drops from $20 to $12. So now 100 shares that we have times $12, it's only worth $1,200. So we've lost $800 of value. What's going to happen in this scenario is a margin call will be triggered. So since the value of our account has dropped, the broker checks to make sure you still have enough equity to meet the 25% maintenance margin requirement. So the total value of our shares, we said it was $1,200 right now. It's $12 a share. We have 100 shares. So our total value is $1,200. And 25% of this is $300. But our own equity is not $300. Our own equity is only $200. So, the $1,200 value of the shares minus the $1,000 that we borrowed, we really only have $200 of our own equity. And when you take 25% of the value of $1,200, that's $300. But our own equity in that $1,200, it's only $200. So it's less than 25%. So we need to have at least $300 in equity because that's what the 25% maintenance margin is. Again, you might need to look at this. There's an article below the show notes, but basically the value of our investment has now fallen to $1,200. $1,000 of that, remember, is money that we borrowed. So really, we only have $200 of that is our money. We lost $800. 25%, a maintenance margin of 25% means that we need $300 in equity because 25% of 1,200 is 300. But again, we only have 200. So what happens is we get a margin call. You're going to receive a call or an email. It means your broker is asking you to either deposit $100 into your account to boost up our equity from $200 to $300, or we're going to need to sell some of the shares in order to reduce the margin loan and raise some of the equity. So you can sell shares to pay off that loan to make it so 25% of the value that we have there is, we have equity in that. That margin maintenance requirement has been met. So you can deposit more money or you can sell shares to reach that margin requirement. Now, if you don't meet the margin call, let's say you don't have the extra $100 in your bank account to transfer to your account, the broker is going to sell a portion of your shares to bring your account back into compliance. So they may sell enough shares either to raise $100 in equity for your account or liquidate the position entirely to cover the full loan. So that is what can happen when you borrow on margin and your equity doesn't meet that maintenance margin requirement, and you're going to need to deposit extra money or unfortunately sell some of your shares. Now, in this example, it doesn't seem like a big deal because, you're talking $1,000. Okay, deposit another $100. But sometimes people get big accounts and they, you've got hundreds of thousands of dollars and you buy hundreds of $1,000s on margin and, some stock goes the wrong way on you and suddenly you're getting a call to deposit, thousands and thousands of dollars and you don't have that in your personal banking account to meet these requirements. And then you're forced to sell shares at a loss. And it could really hurt your account. So you need to be careful of that. Now, there's one other example. I thought we'd just talk through maybe one more so you can get a really good understanding. And here we're going to see that your value of the stock will drop. You won't get a margin call, but we're going to kind of go through the numbers of when that margin call is going to happen. And again, unfortunately, if you're listening to this podcast, you're sort of lost in all the numbers. Certainly, there is an article that has all these examples down that I would recommend you run through and learn and sort of just go over yourself. And that link will be below in the show notes. So let's just talk through one more. This one will be stock C. So it declines in value and it eventually does trigger a margin call. So for this example, let's pretend we have $5,000 of our own money. And then we borrow $5,000 from our broker. So we've got $10,000 and we decide to use all our margin and we buy stock C. So for this stock, we purchased 200 shares and the price is $50 per share. So that works out well. We got $50 a share times 200 shares. That's $10,000 in stock C. Now let's pretend the stock falls from $50 to $35 per share. So now our 200 shares, they're not worth $10,000 anymore. They are worth $7,000. 2,000 times $35 now is $7,000. So the total value of your account is $7,000, but you still owe the broker the $5,000 loan. So your equity in your account is $2,000. It's going to be, the value in your account, $7,000 minus the $5,000 you borrowed. So really your equity is only $2,000, even though, the value of those shares is still $7,000. Remember, $5,000 of that is borrowed. So the maintenance margin requirement, if we assume again that it's 25%, this means you need to maintain at least 25% of the total value of your securities in your own equity. So the total value of those shares, it's $7,000. And if we take 25% of that, that is $1,750. So 25% of 7,000 is 1,750. Your account currently has, as we said, we have 2,000 of equity in this account right now. So we are currently still above the minimum maintenance margin for now. So in this scenario, the stocks dropped from $50 to $35, and we had 50% on margin. We have 5,000. We have 10,000 initially, 5,000 borrowed, 5,000 of our own money. The stock dropped $15 or dropped from 50 to 35, which is a substantial drop, but we aren't in the margin call area yet. We still have enough equity. When we take 25% of the value of our account, which is $7,000 after that drop, that still gives us that 25% of that is $1,750. That's what we need to maintain of our own equity. And we do. $2,000 of that $7,000 is our money. That's our equity. So we are still above the minimum margin requirement for now. So I'm hoping that you can kind of see how that works. But if the stock decides to drop more, and now it drops from $35 down to $30, now our 2,000 shares, they're worth $6,000, 200 times $30 a share now. And what's our equity? Well, remember, we've borrowed $5,000. So of that $6,000, where that's the value of our shares, 200 shares times $30, $6,000, we borrowed $5,000. Our personal equity now, it's only $1,000. And are we going to get a margin call triggered? Well, if we look at the value of our account, it's dropped down to $6,000 now. And if we take 25% of that, that is $1,500. So really, for a 25% maintenance margin requirement, we need to have $1,500 of our own money in that $6,000. But unfortunately, we don't. We only have $1,000. So we are below the required maintenance margin. We're going to get a margin call. And again, we'll get a call, we'll get an email. Our broker is going to say, in this account, you are below the maintenance margin requirements. Please deposit $500 to bring your equity back up to the required amount, or some shares are going to be sold. So in that example, you can kind of see that, as the stock falls, you're not going to automatically get a margin. There's going to be a level that you can kind of calculate, and it's going to depend on your equity, the amount you borrow, the price of the shares, the maintenance requirement for certain stocks. Some stocks are 25. Some stocks might require a larger maintenance margin, some like 30% and so on. But you can kind of see that as the stock falls from 50 to 35, you won't get a margin call. But when it goes from 50 to 30, that's a big drop. It requires you to maintain that that 25%. And in that scenario, you are below the maintenance requirement. You're going to get a margin call. You're going to need to deposit money, or they will sell some of your shares to make sure that you are in a good balance. And really, it's to protect you not going completely sort of under. So I hope those examples sort of made margin calls, and margin requirements a little bit more clear. And I know that for me personally, it was like set up a margin account, but what really is margin? So I'm hoping that, this podcast has helped you learn more about margin. Trading on margin, again, it can be powerful. As you become a professional trader, you're probably going to get way more familiar with this, and you're going to use it in your strategy. You can increase your buying power. Your potential returns can be much higher. But as we noticed, there is risk involved. So understanding the basics like we went over today, margin requirement, margin calls, how your buying power works, it's really essential to when you start eventually getting into trading real money. And when we showed those examples, again, margin can amplify your gains, but when the market moves against you, stocks do not always go up. They can go down. Your losses can be magnified, especially when you have to sell at a loss when you don't want to. That can really, really hurt your account. So always approach margin with caution. Keep in mind the potential for profits, but also the potential for losses. When you start trading your own strategy, you might not need to use margin. Some people stay away from it, while other day traders certainly use it to their advantage. You'll certainly want to know all the risks and make sure you don't go too deep into margin. You don't always need to use your full margin as well. So in those examples, we had $5,000 in our account, and then we decided to use $5,000 of our own margin. You don't always need to do that. You can just use maybe $500 on margin and give you a little bit of boost there and not use your full amount. And that can reduce your risk as well. One other note that I would mention, no matter what brokerage you are with, just go to their website and just read up on their margin requirements, how they calculate it, or what some of their rules about margin might be. There could be this similar, but there are certain brokerage accounts that might have different requirements for certain stocks and so on. So I would recommend that, take this podcast, but then also go and educate yourself further with the specific brokerage account that you are with. So thanks so much for listening. We talked about margin here. In the future episodes, I hope to get back to talking about the specifics of the strategy we're using. But every once in a while, I want to do podcasts about topics like this that I personally need to refresh on and I needed to learn. And I'm sure you in your day trading journey are going to want to understand as well. So there's some other terms like the yield curve and treasury bonds and things like that that sort of keep popping up in terms of the big macro environment that we are approaching and we're currently in. So we're going to have podcasts that sort of jump away from strategy and discuss those concepts as well. And I hope that you do find them useful. So thanks so much for listening. And I will talk to you in the next episode.